In this video, we are going to figure out how to calculate factor values for stocks in the Indian markets. Specifically, today we are going to talk about how to calculate the value score for each company. Now, what is the value score? In some ways, you can think of it, let's say simplistically, the price to book ratio for a company. And we would say that a company with a low price to book is a cheap stock relative to a company that has high price to book. Now that is fairly intuitive, but price to book is not the only measure that you can use as a value score. You can use other things. For example, the most commonly used one would be price to earnings. Other ones that people use are dividend yield. So there can be a bunch of these scores that you can use to sort companies as cheap or expensive. But how do you combine all of these together to come up with a unified score for value, right? So let's just start with a very simple thing. Let's look at price to book as a score, see what happens, and then we'll build from there. Now the big challenge usually is on where do you get the data for calculating these things, because let's say you want to do price to book, you need reliable price to book data. In the Indian context, the best data source that I found that is easily accessible for everybody, where you're not paying a lot of money for the subscription to the data, is Screener, right? And the easiest way to start generating this data is to go to screener.in and create an account. I'm already logged into mine. And you go to screens and then you create a new screen. Now, usually when you are running screens, you want to put filters for various things, but we are going to do a very simple thing. We are going to say market capitalization greater than 2500 crores. Why am I saying 2500 crores? You'll just see in a minute that when you run this query, you're going to get about 1000 names. That is, there are about 1000 companies in India that have a market capitalization of more than 2500 crores. We could look at the entire universe, but you will find when you read the literature on factor investing that usually you want to do this with larger companies, and 1000 is a pretty good universe in the Indian context. Again, nothing stops you from doing this for smaller companies, but for the purposes of this video, we'll just work with that. So I put in this query and then I'm going to run it, and what I'll get is this results. As I said, you've got about 1000 companies in the results. Now you'll notice I've already added columns into the output, but in general, if you do it for the first time, you'll see the columns that you see will be different. In my case, you're seeing the current price, the market cap, the price to book value, the price to earnings, etc. If you want to change the columns, you go click on edit columns and then you can choose the ones you want. Now the ones I have picked specifically are useful for calculating a value score for companies. So you'll see there's price to book, there's price to earnings, price to sales, price to free cash flow, a dividend yield, and EV to EBITDA, right? Now there are about 1000 companies here, and I'm on a paid subscription. So what I can do is I can just click export, which gives me an Excel file with all of this data, right? So now you've got this data in a single file, right? And you'll find that so alright, so let's just start with a simple thing, right? Let's just start with calculating a rank for these companies, these 1041 companies that we have here, based on the price to book value. So what I'll do is I'll add a column here and I'll say price to book rank, right? Now notice that there are some places where there is no value provided in the price to book. Now this happens in two cases. Either the company is very recently listed and so no book value number is available for the company, and sometimes this can happen when the book value of the company is negative, which means that the net worth is negative. In that case also the price to book value will not be there. So just to make sure that we don't mess this up, what I'm going to do is I'm going to sort this data by price to book, right? And so what that does is it puts all the blank fields or the companies with no price to book numbers at the bottom. And then I will simply say rank. I'll give the number and then I select the range. Mind you, I'm assuming you're fairly comfortable with Excel, because that's like basic. You have to start there. Now, in this case, the lowest price to book value of 0.29 is showing a rank of 1003, but we actually want the cheapest ones to have a higher rank or for a better rank. So we're going to just change this and we'll say that we want this in ascending order. Oh, sorry, we want this in ascending order, right? So when I fill this out, whoops, all right, we'll fix this formula. We need to make sure that we use the right range, and you've got the ranks here. Now remember that at the bottom of this entire series are cells where there is no price to book, and therefore there can be no rank. So we are going to delete these numbers, and so we've got these. Now again, when we'll change the sorting, this will mess up the rank. So what we'll do is we'll select all of this and we'll value paste these ranks. So you've got a price to book rank and you've got it sorted, and as it turns out, amongst these 1,000 companies, something called Summit Securities is the cheapest company. Great. However, now if you go sort this by price to earnings, the same data, then it's a completely different company. The cheapest company now is Methane Alloys, with a price to earnings of 4.38, right? So the ranking on a price to book is very different from price to earnings, and what we are trying to do is come up with an aggregate score, right? So we add another column and we say PE rank, and we'll do exactly the same thing. We'll say rank and run this, and once again you remove all the NAs. There are many more companies where the price to earnings number is not available, because these companies are ones where you have negative earnings. So again, we'll do a value paste of these numbers. You've got a PE rank, and similarly we'll do a price to sales, and price to free cash flow, I forgot to sort this. So the reason we are sorting this, the rank function obviously does not need things to be sorted, but we are sorting this because we want to avoid the cells where there is no value available for this variable. Now, this is actually very important as a practical matter. When you build these scores, very often the data is not available, and then the question ends up being, how do you combine data when certain fields are not available? How do you use that in your averages for calculating the value score? So again, we've got 2 more to go. We're going to do dividend yield, div yield rank, and EV EBITDA rank. We're going to sort by dividend yield. That didn't work. Right. Now in this case, remember that the dividend yield, the higher the dividend yield, the cheaper the stock, and therefore we are going to reverse the sorting order, and we are going to rank it in descending order. So the lowest dividend yield, which is 0 naturally, is considered as the worst rank, and the highest dividend yield is considered the best rank. So a 7.62% dividend yield is rank 1. Again, value paste, and finally EV/EBITDA sort. And once again, EV/EBITDA, the lower the number, the cheaper it is ideally. In the case of, so we've done this and I've made a mistake, so it's worth looking at what the mistake is. So remember that the way in price to earnings, we don't have a PE rank when the earnings are negative. Similarly, when your EV/EBITDA is negative, then it essentially means that your EBITDA is negative, and if your EBITDA is negative, you don't want that means that if there's a high price and you've got a negative EBITDA, then this number looks low, but that doesn't make the company cheap. So we are going to avoid ranking these companies. We're going to say that the rank is not available, and we're going to begin ranking from the point where EV/EBITDA is actually positive. And so that's the range. And we're going to value paste. Actually, similarly, we've made the same mistake in price to free cash flow, because you've got negative free cash flow companies, and a ratio on a negative free cash flow does not make any sense. So we're going to sort that as well again, and we're going to recalculate price to free cash flow. We're going to ignore all the cases where the free cash flows are negative. There's a long list. Free cash flows are much more negative much more often than earnings. Alright, and that's it. So we're going to eliminate these companies, and we're going to re-rank. Excellent. Now you might be tempted to simply take, when we want to calculate an aggregate score or an aggregate rank for, a value rank for every company, it's very tempting to simply take an average of the ranks that we've got on each of these parameters. However, remember that in some cases we are only ranking up to, let's say, 700 companies, or sometimes even fewer than that, right? So the max and the min ranks, or the maximum rank in that particular column, is very different. So you can't simply add those ranks. You need a mechanism to normalize these ranks and then put them together. Now this normalized rank is called a Z-score or a Z-score. The Z-score can be calculated for a distribution of any sort of numbers. What it simply does is you take the number, you subtract the mean, and you divide by the standard deviation. Essentially, you're turning everything and you're putting everything on a curve. When you do that for numbers in different distributions, then you can actually put them together. You can add them because they are all normalized to the same scale, right? So again, we'll very quickly do that. Again, just to make life easy, we are going to do price to book rank sorted, and we're going to say PB rank Z-score, and this is going to be this minus the average divided by the standard deviation for the same thing. Okay, and just do that, and we'll do this, and so you've got the Z-score going from minus 1.73 to plus 1.73. Okay, and again value paste everything. So the same thing for PE rank. You know, it'll be easier if we just use filters. Let's sort by PE rank, add a PE Z-score. And remember to delete all the. Notice something interesting. So once we've put everything on a Z-score, the minimum that you got on the price to book range was also minus 1.72, and on the PE rank also now it's minus 1.72, and that same thing is going to happen with all of these variables, right? Let's just add the columns. PSC score, just to be careful, add filters again. Once again, sort. And finally, so that's it. Now you've got all your Z-scores. Now you can average them, right? Now the beauty of using the average function instead of simply adding all of them is that if one of the fields is missing, the average will automatically correct for that and will not account for it. So let's say that you've got price to book, price to sales, etc., but you've not got the price to earnings rank because the earnings were negative. Then in that case, when you use the average function like this, it will not use the empty price to earnings score for the averaging. So you've got all three scores here and you add them up. Now you just run it for everything and you've got a score. this is your value score. And now we can simply sort this from smallest to largest. And lo and behold, we've got a completely different ranking. So this company that on the aggregate value score looks like the cheapest company is actually ranked 104 when looked at on a price to book basis. It's ranked third on price to earnings. Price to sales is also 3. So expectedly the ranks are pretty low on most metrics. But as you go down the line, you will see that the numbers can be very mixed. Sometimes there are companies with very high price to book scores, but they seem fairly cheap on a price to earnings basis, etc. So that's it. You've got the value scores for every company. And now if you are just looking to buy the cheapest possible stocks, you've got your rankings, and you can buy the top 20% of these companies, build a portfolio. Other interesting things you could do is you could say that I don't want to buy small companies. I want to buy only companies with market capitalization greater than, let's say, 25,000 crores. So you could simply do that, and then you pick your top 20 companies. So you've got, as you'll see here, about 300 odd companies when you put that filter, and you could build a portfolio of 60 odd companies, which will be the top 20% or the cheapest 20% of your companies, and you would have your value portfolio. So that's it for today. There's much more that we can go into, but this is just to get you started. Maybe play around with this a little, and then we'll do something more next time.